Alright, this is Ubaid on behalf of Electronics, and in this video we're going to be talking about the International Monetary Regime. Okay, now when it comes to the International Monetary Regime, it has to do with standards. Okay, so say for example you have a base currency and you're using that base currency to figure out the foreign exchange rates for different currencies around the world. Okay, for other currencies around the world. And this has to do with the International Monetary Regime. And one such monetary regime, this is your specie standard. Okay, so this is specie standard. And basically what this specie standard is, okay, this was developed before World War II. And basically what it does, it uses gold as the base currency when it comes to exchange, for example. Okay, so you have gold in reserves, gold in the bank's vault. Okay, this is what's used to figure out the exchange rates, to convert gold into different currencies. Okay, so when it comes to your specie standard, okay, they do have a fixed exchange rate. And on top of the fixed exchange rate, you also have a capital mobility. All right, so that is your specie standard. The next system that came into existence was the Bretton Woods system. Okay, this is from World War II till 1970. So we're talking about till industrial age. Okay, so this is your Bretton Woods system. And the Bretton Woods system used US dollar as a base currency. So when it came to foreign exchange rates, when it came to comparing foreign currencies, okay, all the countries around the world would use US dollar as a source of comparison. Okay, so this is your Bretton Woods system. Okay, uses US dollar for comparison. All right, now when it comes to your Bretton Woods system, it does have a fixed exchange rate. Okay, so this is fixed exchange rate. Because at this point in time, okay, the exchange rates are not based on supply and demand. Okay, rather they're based on US dollar. Okay, so fixed exchange rates. Okay, they do have discretionary and monetary policies. So unlike the specie standard, okay, in a Bretton Woods system, the central banks are allowed to impose a monetary or a discretionary fiscal policy, for example. Okay, so this is monetary policy. And apart from those two, you also do not have capital mobility when it comes to the Bretton Woods system. Okay, so no capital mobility. All right, now apart from these two, you also have the free float system. Okay, and this system is basically present in some countries around the world. It started back in 1973 and is still present in some countries around the world. And the free float system basically relies on supply and demand when it comes to the market to figure out the exchange rates. Okay, so the free float system. Okay, this is supply and demand. So back in the days before 1973, okay, what ended up happening was because of recessions, inflation, and other economic disasters, okay, the U.S. currency wasn't considered stable enough for countries around the world to use U.S. currency as a base currency. Okay, and because of this, what ended up happening is countries around the world, certain countries around the world, they developed a free float system, okay, which basically relied on supply and demand in the market. Okay, so this is supply and demand. Now, apart from that, okay, the central banks in a free float system do have the capability to impose a monetary policy. Okay, so monetary policy, that's a yes. And going back to your monetary policy, this is where the central banks may buy treasury bonds from the commercial banks, pump money into the system, into the banks, as a result of which the banks are able to supply loans and mortgages, and the central banks are able to lower down interest to get out of the inflationary economy, okay, to get the economy out of inflation. So this is your monetary discretionary policy. Now, apart from this monetary discretionary policy, you also have capital mobility when it comes to your free float system. So free float system, there is definitely capital mobility. All right, now apart from that, you also have a managed float system. Okay, so what exactly is a managed float system? Now, in a managed float system, okay, the exchange rates are sometimes fixed, okay, because obviously in a managed float system, even though there is supply and demand, okay, the exchange rates are sometimes or occasionally fixed. Okay, so this is fixed exchange rates. Okay, and again, even though the exchange rates are fixed, these central banks can impose monetary policies occasionally when need be. Okay, so this is central banks may impose monetary policies. All right, and again, you do have capital mobility over here as well. So capital mobility is a yes. Okay, and given all these facts, okay, we know that these are different types of monetary regimes and their practice around the world. Okay, one such example would be China. Okay, or even India. Okay, where you have a managed float system. All right, so having said that, that would be it for this video. On behalf of V Electronics, this is Ubaid. Have yourself a great day.